And this leads me to this only one thing I'll say. If you're somebody out there that is just scared to death of the election or scared to death of the market or scared to death of everything else, but you're exposed to the market, this is a great time to get some advice and know your number and figure that out, because if you have to reallocate, this is the time to do it.
Welcome to the Market Moment. This is Matt Walters, and today I'm here with Eli Freeman.
Excited to be here.
And John Martfeld.
Hello.
All right, a little echo in the room. So excited to jump in today. A lot going on. Market's reacting in a pretty big negative way as we open up the trading week. Yield curve is uninverting for the first time in quite a while. So we're going to jump into that. So let's start with the yield curve uninverting, literally like in real time.
Yeah.
And now this can go either direction. So we could wake up tomorrow and things go back the other way. But as of where we sit today, the yield curve is uninverted.
So there's some fancy language there. I'm going to give just a little bit of backstory before we go into what the yield. So yield curve is short-term rates versus long-term rates. So in a normal traditional environment, your short-term, if you went to the bank and bought a short-term CD, you would earn less on that CD than a long-term. But over the last couple of years, I think everyone has seen it. 1-year CDs are what everyone's buying because the 1 year is 5.3 or 5.4, and the 2+ year CDs have been lower than 5%. So the short term has been higher than the long term.
So a normal curve, sorry to interrupt, but a normal curve is a curve that is sloping upward and to the right? So the further out you go, the higher the rates go. When it's inverted, when you're looking at like a 3-month, 2-year, 10-year, 30-year, 20-year, 30-year treasury, whatever, when it's inverted, it's sloping down and to the right, right? So the further out you go, the rates go down.
And why that's significant is it was Harvard, I believe. There was a Harvard professor that studied when yield curves invert. It has, with 100% probability, except for this current instance, predicted a recession.
Right.
And what we're seeing today is that the yield curve is getting back to a normal yield curve. The 2-year and the 10-year, as we speak, are basically the same rate. If you bought a 2-year or a 10-year, you're getting paid the exact same interest rate. So significant, insignificant, I don't know, but it's definitely something that's interesting to watch and something that we're seeing.
Well, it's healthier. Like an inverted yield curve is not a healthy thing forever, because you should be rewarded for your risk if you're going out longer on the curve, right?
Do we call this uninverted? What do we call this at the beginning?
I've said that so many times, I don't even know. It's uninverting currently.
Yeah, uninverting. I think you should have to say that 10 times real fast. Okay. But here's the deal. All my years of doing this job, I have been told the very same thing you stated there, that when the yield curve does that, what it has been doing for the last 2 years, that you're going to get a recession. It was 100% proof of that throughout history, right? And then we didn't in this cycle. And then today we have it kind of leveling off, and it's like you said, it looks a little healthier. Meanwhile, the market's getting crushed today.
Right.
But we know it's a short. I mean, this is all, if you go day by day, you'd go drive yourself nuts trying to think that's the way we're going for a long term, right? But I don't know what to think about this me personally, and we've kind of laughed about this. I'm the bear in the room, even though I am a bull my entire career of doing this.
Yeah, and I've got a chart for that.
Yeah, and I've been a bull my entire career, and then the last few years I have been the opposite. Not because, I think I'm smarter than anything else. It's just all of the stuff that I have learned my entire career. This market is not acting normal. Yeah, and it goes to that one is one of the keys. But we have other things. I remember several years ago, and this was before COVID, but if the 10-year treasury got above 2%, we were in trouble. If the 10-year treasury got above 3%, we were in trouble. You guys remember this talk? And it just kept going up, and we never got in trouble, right? So the markets are acting unusual. And I do think, even though we're getting that uninverted yield, that I'm not claiming that as victory yet. Like I still think there's a lot of weird stuff. In all my years doing this, is the hardest market to predict, in my opinion, because of all the weird things going on, including We've talked about this before, but the M2 measure money, the Fed's role, the banks having no reserve requirement, and that happened in 2008, that we really don't know the consequence of that because rates were so low for so long and that didn't really affect the economy, but it now is. There are so many things that are unusual, weird, and this is one of them. And I'm kind of like, it's hard. This is the beautiful thing about what we do at Mach 1 is it doesn't matter. We take the client's risk tolerance and their expected, what we need to get for them, and we try to take the least amount of risk possible to achieve their goals, right? Yeah. So it doesn't affect, we do the right thing for our clients, but a lot of people out there, if you're following this, trying to follow the science of it, good luck.
And this is something that has an impact on probably most investors. A lot of people with cash at banks or just cash that they're sitting on are purchasing short-term CDs. Some people buy treasuries. You'll see it in money market accounts where you get the yield in money market accounts. If we start to see the short end of the yield curve, this 2-year that I'm referring to, come down, everyone is going to know it because they'll see CD rates drop to the 4s.
Oh, they're already.
The 3s.
I mean, you're seeing it happen in a preemptive strike, knowing rates are going down right on the Fed side. You're already seeing like our clients coming in. Well, when we look at our guaranteed rates that we look at and I look at them daily, and I'm sure you do as well, they're going down. I mean, we're having consistent changes, and it's all kind of negative changes.
What was it, 4 months ago, you could go buy a 5% CD pretty easy on the open market. Now we're at, I looked today, it was like 4.3.
Right, which is pretty tremendous. So that's forward-looking markets when the rates really haven't fallen that much, but that's kind of what happens.
Well, what got us in this situation was rates were at zero, essentially zero.
For a
they
long
were
time.
at zero, the Fed funds rate, and then they increased them by 500%.
Right,
very short
in
order.
a year.
And the market was looking out. It's like, okay, we don't think rates are going to be this high 10 years from now, 20 years from now. So that part of the curve did not increase. Right, rates were not going up at the 10 and 20-year terms.
Basically calling the bluff.
Yeah, nearly as quick as they were at the short term. So they were like, hey, this is going to be a short-term thing. Short-term rates shot up, long-term, and that's just. When I say that's not healthy, it's just not. It's not healthy. Like you want a normalized yield curve where, hey, if you go buy a treasury or you borrow money or you lend money at the short, for shorter term, you're paying a lower rate than if you get it. It's like, think of it like this: like, would you be as incentivized to go get a 15-year mortgage if you were going to pay 50% higher rate than you would on a 30-year?
No,
right? It wouldn't make any sense. And that's, everybody would be like, well, why wouldn't I just get a 30 with a lower rate and then pay it off sooner? You would, right? And so that's weird. That's kind of the weird stuff that you would get into if everything was acting like the current yield curve. When things are normal and healthy, it's like, no, you borrow money for a shorter period of time, 15 years, you're going to get a better rate.
So here's an interesting question. 6.2, according to YChart's money market, $6.2 trillion in money market funds. If rates go down to 2% on money, because money market funds have been 5%. If rates go down from 5% down to 2% in these money market funds, where does that money go, or does it stay?
Well, it's pushed. So in my opinion, and then going back to one last thing on the 10-year, there is a supply and demand issue as well. And the old school way of it, if the 10-year treasury started having pressure and the interest rate going down, that is a sign of a recession in its own self because more money is flowing to those. So the interest rate gets, the demand is higher than supply.
Right.
So interest rate naturally comes down. So lately it's been kind of like, why is, we know what you just said was correct, but it's a combination of all that. If money starts to go down, if our money market goes down, I think that money typically, historically, would flow back into other areas such as gold, dividend-producing stocks,
fixed income,
high quality fixed income. But it doesn't mean that's what's going to happen. But because gold is this is another reason why this is so crazy. Gold is at near all-time highs, right? Stock market's near all-time highs. 10-year treasury, the inverted yield. There are so many things that are kind of out of the cuckoo for cocoa nuts right now that if it goes down, if the money market does go down, and people will, that money will go somewhere, to your point.
You think?
I think it will, but where is the question? And I think that the bond market has a chance to get some of that. I think
it's not an all for nothing.
Dividend type of stocks have a chance to get some of that.
I don't think it's an all or nothing thing. I think there'll be
sure.
money that stays in money markets.
Always. Yeah,
I think there'll be money that flows out. I know there'll be money that flows out. Just like look at some of the things that we do. You know, a client comes in, new client, a lot of money, market's at all-time high. You may dollar cost average in over the next 6 to 12 months,
Exactly.
right?
Yeah.
And so like there's going to be things like that that's happening. It's just a matter of what percentage. So of that 6.2 trillion you said, you know, is it 10% or 40%? And I don't know, but some of it's going to make its way back into the market. But
How about this? Pre-COVID, so beginning of 2020, first quarter of 2020, there was 4.7 in money market.
before COVID, when was that?
So first quarter
2020.
of 2020.
Yeah, 2020.
So 4 point, and that was when money markets were paying nothing. 2020 money markets were paying.
Now the money out there we've had this influx of money, right? Just from the government, from everything else, which attributes to some of that gain. Then you have interest rates just being 5% on $1 trillion is a lot of money, right? So, I mean, you have some of that growth from internal, and then you have some money that, you know, if you watch the business channels, good luck trying to find, because one analyst will say this is going to happen in the market, like it's over.
Yeah.
And the other analyst will say, oh, we're going to have a soft landing, everything's going to be great. And they're both very smart, and they both have very good points. And that's the point.
Yeah.
It's really hard at this moment to
Some
get
of
your
that
hands
money in money market will come out of money markets, and it'll just be spent. Because there's people that are planning for things, or maybe they've parked money for a new house.
Right.
And they're like, you know what, we're not in a huge rush, but we're going to wait for rates to come back down. And when they do, they get out of the money market, and then they go spend that. You know, they go put the down payment on a new house, or they go. So like, there'll be a lot of things done with that money. I think there'll be money that absolutely stays in money markets. There'll be money that comes out and is just put into the system as spent, and then there'll be money that's put into the market.
But if the money goes into spending, it helps the economy as well. The
Sure.
point is, all of that money in money market, regardless what the rate happens to the rate, is good to hear, because that's money that can be spread into something else, whether that's spending, which helps the economy, whether that goes into the stock market, whatever, it helps the stock market. So, I mean, it's good. It's not a terrible thing. But again, for 15 years, we've had that 0% rate. We had this little tiny time frame, and it's going to be tiny when you look back in history, that we had this nice bump up, and now it's going to start coming back down. But I'm kind of curious. We'll have to have this conversation a year from now. Like, is it going to go all the way back down to 2? And I don't think so. You know, I mean, I think it's going to level off somewhere where you're going to have to make a decision. And do I want 3.5%, or do I want to take the risk of the market? You know what I mean? Like from 5. So anyway.
Well, it'll be interesting to watch that. I have my opinion. I don't think much money is going to move out of money market funds. If you watch people and how they manage their bank accounts and how they think of how many people have bank accounts that are paying them nothing, when they could go set up a high yield savings account and go get 4 1/4,
Sure.
right?
Yeah.
Like that. Yet everyone still has bank accounts with probably most of their cash sitting in bank accounts. So cash is sticky. It doesn't move nearly as quickly as we would like to anticipate. Like the efficiency of cash is
Right.
not there.
I feel like some of that, though, is the cumulative effect of a lot of people with like a little bit of money in their bank accounts adds up to be a lot. So when you look at the data and you're like, hey, there's trillions in bank accounts and stuff, it's true. And some people probably have like ridiculous amounts, way too much. But I think the average person still just kind of has more of a reasonable emergency fund or less kind of balance. But there's so many people out there, there's so many bank accounts, that when you look at the total numbers, it looks like this crazy number. I think some of that's true with the money market is, that's why I say like, it's all right. Like all of these things are going to happen. Like some people are going to keep it in money market. Some people are
you
going to
think
move it
differently,
to the
John?
No,
market.
just go back to 2022, and if you look at how much money the average American had saved in 2022 versus today, and you look at the average credit card debt in 2022 as they have today, those numbers to me aren't good. Like you're seeing a lessening of savings account money. And so, yes, there's all this new money, I mean, this big money that's in these accounts, and it's got to be accounted for somewhere. But I'd say the middle class with the inflation stuff, and if you look at the data, middle class and under, it's not that pretty. I know it's not like every American has an equal amount of money in a money market or whatever. I think it's upper middle class and higher that are in participating in most of that. Because I do know, when I was watching the channel this morning, they were talking about savings rates is coming down, and credit card debt is at all-time highs. There is So some of those funds might go off to pay some of those things off or whatever. But I guess I'm probably being more confusing than I'm making clarity here. And that's the point. I have less clarity about where things and what things are going to happen than I've ever had in my career. And so I like hearing what you guys are saying, because I think all that makes me feel better. And I hopefully everything's just normal, and this uninverted yield stuff that's going on now, I hope that's a trend. And again, because all my life I've been told that the last 2 years we've been in a recessionary signal thing, and it really hasn't happened. Yeah. Anyway, so I'm a little more confused so I'm sure I'm confusing everybody.
One of the most interesting charts, which I'm struggling to find, is credit card debt that's inflation adjusted. So if you look at credit card debt's all-time highs, so is literally everything else.
Right.
Every asset class, everything is at all-time highs. So you have to bring it to some form of normalcy, which would be inflation adjusting, or you could take it to wages.
Well, I look at if they're capping out their credit cards, they're not going to spend anymore. So I don't look at it as, I know what you're saying, but I don't look at it as that broad, because it's not like the U.S. federal government where every time we run out of credit, we just go get another $1 trillion added to our credit. Mm-hmm. Most Americans don't have that option. Most Americans, if they hit $10,000 credit limit on a credit card, they're not going to get it to 15 because their credit score stinks. They don't have the ability to pay off that. And so I know what you're saying, and I agree with, again, I'm wanting to hope that everything is going to be perfect. It's just all my life and all these numbers I've looked at all my life, these are terrible signs in the economy. Terrible. Mm-hmm. Regardless of what the inflation rate is, regardless of anything, they're terrible, historically bad signs. But I've been, wrong for a year. So, I'm hoping I'm wrong forever. I hope that we don't have any issues and everything works out rosy and nothing is a problem and all these things. Yeah. And I hope so. And I'm hopeful.
If you do hear anything from the conversation, if you have CDs, you have treasuries, they're likely going to start earning you less and less, especially if you're on the short end of that curve, the 1 years, the 2 years.
That's the bottom line.
That's the bottom line.
And most people are, because that's where they were getting the 5+%.
That's where the money was at.
Yeah. Oh, yeah. So most people aren't locked into like a 4 or 5 year something. So
and the banks are smart too. They're not offering anything past 8 months.
Just have a plan for when that stuff starts coming, due, and figure out what you need to do with it.
Yeah. If you're not happy with 3%, then what's next?
Right. I don't know what we just accomplished, but
I know.
Good conversation. So the market started today. This is real time as of 2:00 on Tuesday. All the major indexes. Dow's down 1.5%. S&P's down 2%. Nasdaq's down over 3%. Russell's down just under 3% since the open this morning. So big red day in the market. Eli, you've got some stats on September being a historically bad month. I think you said earlier September has the most down 1% days, first day of trading in the month.
Here's what you're referring to. So this is from Bespoke Invest on Twitter. It says, of course, September has the most number of 1% declines on the first day of the trading month. And September's had 14 1% down days on the first trading day. The next highest on that is tied for January and October at 11. Most of them are around that 5 to 7.
Right.
So and if you look at some more posts of just about the month of September, this is Liz Ann Saunders. September's historically been the worst performing month for the S&P 500 since 1928. It's finished higher only 43% of the time, with an average decline of 1.2%.
Yeah.
So the rest of the month should be great because we're down we're down the average today.
We're done.
We're done. Market's closed for the rest of the month.
Yeah, that is interesting. I don't know what you can attribute that to.
Yeah.
I know they say, October is not a great month for trading or investing either, and a lot of that used to be attributed to the year-end closes for mutual funds, right? So they had to do all of their trading before their year-end, which was the last trading day in October. So that makes some sense, but I don't know the September deal.
Yeah, it's interesting. Actually, I just did a data brief on something similar to this, and I'll shamelessly plug the data brief. So if you go to YouTube, there's a series that I do, and we just did one on election years. So it's years of election, midterm election, and how performance varies. And it is so hard to look at those numbers because they're aggregated over 30, 40,
Sure.
50
Right,
years
right.
and make any kind of conclusive as to
Right.
what you should or should
Right,
not do.
right.
Because, for example, year 3, which is what we're in, right before leading up to the election, and the range of returns just in this year, it ranged from being down, I think it was 30 or 40%, and being up 35%, with an average return of 9.1%. And
Right.
so it's to say that this is going to be the average year or this is going to be the down 30. It was a 70% difference from max down to max up. So these charts are always interesting, but to come up, just like you said, to come up with a conclusive, oh, I should do this.
You know, you should know what you need to make in return, and you should know, you know, your retirement plan and all that kind of stuff, so that if this bothers you, if the market going down 500 points, 1.5%, whatever today, if that bothers you so much, you should definitely talk to somebody and get a plan done, right?
Absolutely.
And us as the number one option. But, you know, I look at it like markets are near all-time highs, even with today's loss. We had a couple weeks ago where the market was down the exact same type of, you know, terrible Monday, and we had like a week-long straight of sell-off. The Dow was down to like 38,000. It bounced right back up to 41,000. Now we're coming off the 41,000. And so we're still trading at this high spot in the market. And this leads me to this only one thing I'll say. If you're somebody out there that is just scared to death of the election or scared to death of the market or scared to death of everything else, but you're exposed to the market, this is a great time to get some advice and know your number and figure that out. Because if you have to reallocate, this is the time to do it. We're at the all-time highs of the market. If it's time to take some risk off the table, this is a great opportunity to do that rather than waiting if the market does fall apart and you're trapped in that.
Yeah, looking at rebalancing is something to be considering.
I think,
with equities. And I saw a stat that was currently U.S. households of investment accounts hold about 42% of their net worth in stocks right now, and that's one of the highest levels in history that's ever happened. And a lot of that can be attributed to several just
some good growth,
15 years of really good growth. So it's worth, if you are in that bucket, it's always worth considering to make sure that your risk tolerance is kind of in line. And that would be.
What do y'all think the most, and this is not a right answer to this is just opinion, which I have my own, which is why I'm asking you. What do you guys think the number one like variable or factor is when considering investing?
Number one factor?
Like, what's the most important thing that you should know and understand before you're deciding this is what I need to do with my money?
It's a great question. I'm not going to answer it with just one. Can I do 1A, B, C, and D?
I'd prefer you don't.
I would think for me, it's because we do this with our planning all the time, but it's basically what your expenses are going to be in retirement. And I mean, that's the first question that I'd want to know from somebody.
So that's what you tell a 20-year-old?
Well, yeah, 20-year-old, you can't. 20-year-old to me, completely different. But yeah, if you're getting close to retirement, expenses to me are number one. A 20-year-old, look, a 20-year-old has nothing to worry about. If they are talking to us and they're investing, they've already won.
So I'm thinking
They're winners.
I'm thinking higher level than you guys. So here, I'll tell you what.
Mine was going to be know yourself. Like if you can fully.
So just understanding your risk tolerance.
Understanding yourself to the fullest extent that you'll get the highest returns that you can, taking the risk that you yourself are willing to take.
Which very few people fully understand their risk tolerance until they
until they lose it.
Yeah.
So I would this is why I asked the question, because I talk about this a lot, and again, I'm not saying this is right. This is Matt's opinion, but
that he had time to think about.
Wrong.
Just throwing it at us.
Wrong.
I think the number one thing that you should ask yourself is, what is the money for? So understanding your time horizon. Any dollar that comes through your ecosystem, your bank account, your 401k, whatever it is understanding your time horizon. Because they always, you always get asked the question of like, well, should I invest it? And it's like, well, when do you need it? Like, what is it? What is it? What is it for? Right.
Yeah.
So that's what I was saying. I was talking about higher level, because there's not it. If you don't know when you're going to need it,
right,
then it literally, I say this all the time to people. It's like, I can't really give you advice on what to do with it. But if you're sitting here, this happened a week or two ago. Someone was saying, they're like, well, I might need it in like 6 months for this, but there's a good chance I'll never need it.
right. Good luck investing.
And it's like, I can't tell you what to do with it, because if you need it in 6 months, that's very, very different than if you never need it.
Yeah.
And so anytime you've got a decision to make in terms of where to put money or what to do with it, have those dollars allocated for a specific purpose or reason, and know what the time horizon is, because that's going to very quickly at least steer you in the right direction for, here are the appropriate options and
Yeah.
what I should be considering. And it should very rarely be, I'm considering a money market fund and the S&P 500
Yeah.
index
Yeah.
for the same dollar.
Yeah.
Right? Like, you're going to limit your options and the mistakes that you make if you understand your time horizon.
I agree totally. One of the biggest mistakes Americans investors make is allowing emotion to control their investments, right? Mm-hmm. So in 2008, when we went through the financial crisis, I had clients that lost, 20%. They were aggressive. Mm-hmm. They thought they were aggressive. They were down 20%, 25%, and they pulled everything out, and they never went back in.
That's a humble brag.
Right. No. That's not an aggressive person.
All my clients were down 25%.
No. I had some that were down far worse. I'm just saying like that. I think that we as the advisor have to guide pretty strongly through this, because people have the fear of missing out, FOMO, right? So since 2009, if you have not been in the market, you have missed out on a historic run.
Yeah.
A 15-year historic run from 6,400 on March
S&P is
7th
like 15% a year
on the Dow to 41,000 on the Dow. That's historic, right? Going back to the Great Depression. If you've missed out on that and now you want to participate in that, in my opinion, I don't think we're going to go the same percentage the next 15 years. It's just hard to believe that can be sustainable. Mm-hmm. So a lot of our investors will think that's the norm.
Right.
And they've been in their 401ks and they've just seen their 401k and they come in to see us or anybody else, and they just expect they're just going to keep, and I think setting expectations for clients, but knowing what the money is for, and then I'm going to say knowing what they need to live on. You can pair those two to find out the return they need, and then you can compare that to what they're, because how many times are you going to do a retirement analyzer like we do at Mach 1? Comes back, says the client needs to take 5% risk on their money to make it through the end of their life, to make it to age 100. And they're taking far more risk than that. Mm-hmm. But when you tell them they don't have to take as much risk, they hesitate. They don't want to do that because it's been such a great ride and they just think that's the norm. Anyway, I'm rambling. But
no, yeah.
All these questions. But that your question and all the things we're talking about, we get all of that from our clients when we do a plan. And then we help you through the emotional roller coaster that is the market.
There's a lot that Dave Ramsey says that I don't agree with. There's a lot that he says that I do agree with, but there's plenty that we don't see eye to eye on. One thing I think that he hits home on, and it's like the most basic thing that he teaches, is the value of having an emergency fund, right? And giving yourself the flexibility and the options of, and I know he doesn't come at it from a investing perspective necessarily. He comes at it from just more of like a needs, like catastrophic, something pops up. But even when you're investing, having that emergency fund, one of the most important things you can have as an investor is flexibility of when you sell, right? You don't want to be caught and put yourself in a situation where I have to sell because I didn't have enough liquidity in the right places. And so now I'm having to sell at a very poor time, right? And so that goes back to knowing your time horizon for each specific dollar, having an emergency fund, having money that's not invested in the market. So when those needs come up, if your accounts are down, if your investment dollars are down, you're dipping into those other buckets so that long-term money can stay long-term money. And that's where people get themselves in a bind, is some people can almost get overinvested. That's not the norm. Most people are underinvested, but some people can get overinvested where if they need any money, they're selling their stocks or ETFs. Or
that's where when you're working, you shouldn't have much more than 6 months ever in emergency funds, unless there's something that you're planning to purchase.
Right.
When you get to retirement, you can start to make a case for 6 months to maybe even as far out as like 2 years worth of low risk type of investments, so that you're not that forced seller. We're in a market correction and now I need to sell my stocks type of investor.
Totally agree. When you're in retirement, you're no longer getting a paycheck.
No.
Having that 6 months to 2 year makes more sense because you did get fired. Right. I mean, on your own accord, but that's what happened.
Yeah. Well, there's investing is not easy. staying the course, making all the right decisions is difficult, especially when things get volatile, right? You start second guessing everything.
Oh, yeah.
When things are volatile. And so just having a plan, sticking to it, having someone that can help hold you accountable is extremely important. So any parting thoughts? Today was a little bit more of just kind of conversation, but
Yeah,
it's good stuff.
my parting thoughts are investing's not easy in the short term. In the long term, it's a lot easier.
Mm-hmm. Goes back to time horizon.
Yeah, it does.
Yeah.
It does, Matt. You are a genius.
Yeah, thank you. I've been just waiting for someone to say that so we can get off the podcast. So we've got a big Arkansas OSU game this week.
Yeah.
So Eli,
That's a good prediction for me, Eli.
Elijah Freeman is
It's a lose-lose for me.
Yeah.
If we win, I don't get to celebrate in the office because it's just
You
it's
can. You can.
Then I'm just that guy.
Yeah.
And if
We're gonna be that guy
If we
beat
lose,
you.
I'm gonna have that guy all over me.
Yeah. I get that.
Prediction: I think we're winning by 10.
I think Eli's winning by 10.
Arkansas.
I didn't like the way we looked last week, and I think we make it more of a game than I thought we would have a week ago.
I know.
But I think the Cowboys, if both teams play well, they'll beat us.
This isn't Oklahoma PB though, unfortunately.
Yeah.
We just played UA PB. This is not UO PB. This is a really good school, and I actually think Oklahoma State is like a dark horse chance to get in the final 12 this year.
Yeah,
because of their conference, because they are probably the best team in your conference, right?
Yeah.
It depends who you ask.
Yeah.
Well, I know, but they're pretty good. They're pretty talented. They got a running back that apparently is like the best in the country, basically.
Yeah.
Like the JV conference. So
Yeah, in the JV conference. But Arkansas I was pleasantly surprised, 70 points on, regardless, that was the best look we've looked in a long time. But again, the competition. It'd be fun to see if we can just hang with the Pokes for a little while.
Yeah.
It'd be nice to see a good game.
Back when I was in high school and I played basketball against middle schoolers, I crushed them.
And your team that you guys played, hey, to give him credit, the team that he played had won 48 straight games, I believe, and they were the division.
I actually felt bad for them. I was like, they've crushed their division.
Oh, no, they've crushed.
South
They've
Dakota
won the
State,
national
yeah.
championship several times in the division below, and it used
Props
to be
to
Division
them.
2, whatever. But
I just hope
they weren't a bad team.
I hope it's a good game.
Yeah.
It's
Yeah, I
a
hope
good
so,
game.
too. I hope so,
It'll be
too.
fun to talk about it next week. And if Arkansas loses, we won't talk about it.
Yeah,
So,
we won't have time.
yeah.
We won't have time.
All
We'll have
right.
to-
Well, as always, we appreciate you guys listening and joining us. Remember to join the growing online market moment community by liking, subscribing, or leaving us a comment. We appreciate it. We look forward to seeing you guys next week.
God, that's fun.